In today's episode, I'll talk about two interesting stories. In the first story, I'll talk about how Greece went from being Europe's biggest economic disaster to one of its fastest growing comeback stories, and also the painful journey that it took to get there. And in the second story of the day, I'll talk about how India is launching electricity futures for the first time ever and why that could change how power is traded in our country. Welcome to the Daily Brief Show by Zerodha, where our aim is to cut through the noise and simplify the biggest news and stories in the financial markets in a way that is easy for all of us to understand, yet one level deeper as compared to your traditional news channels. I'm your host Anurag Bansal, and today is Thursday, the 10th of July. On the show, we've talked very often about how most of Europe has been going through a downward growth slump lately. But the truth is that not all European countries are struggling right now. See, while the broader European Union is dealing with slow growth and economic uncertainty, there is one country that really stands out as a surprise performer here. That is the country of Greece. Yes, it is the same Greece that was just about a decade ago the poster child of an economic collapse. Now, back then, its economy was in shambles, so to speak. It was buried under unpayable debt, and the rest of Europe saw it as a cautionary tale of sorts. But today, it is one of the fastest growing economies in that region. Investor confidence is returning, the unemployment rate has dropped to its lowest level in 17 years, and Greek bonds, which were by the way once considered too risky to touch, are now in high demand. So in short, Greece seems to be making a comeback, and a very, very strong one. But that said, this turnaround did not happen overnight, and also it certainly did not even come for free. So to understand how Greece got here in the first place, let's quickly go back a few decades. See, Greece's economic troubles did not start in 2008. They had been building up very slowly for many years, and that is largely because of how the government managed its money. See, ever since the 1980s, the Greek government had been spending far more amount of money than it ever earned. It heavily subsidized its public sector companies, it offered generous welfare benefits, and it paid government employees much more than their private sector counterparts. The public health and pension systems were also fairly well funded, and many people could retire relatively early as compared to other countries. Now, of course, on paper, this seemed like a country taking care of its citizens. But in reality, this level of spending was unsustainable. These generous policies bred inefficiency. Public sector companies were bloated and unproductive, and they relied on constant government support just so that they could stay afloat. And social schemes were not well managed either. And as the government kept spending more and more amount of money, it also had to keep borrowing more money. And by 1993, Greece's debt had already crossed 100% of its GDP. Inflation was one more constant worry here. Now, I know a lot of countries do run high on debt levels, but that said, Greece actually had very specific weaknesses that made it very vulnerable. Its economy was built around two major sectors, tourism and shipping, and both of these are very deeply linked to global trends, and they are highly sensitive to international disruptions. But outside these, the rest of the economy was not strong. Manufacturing contributed just 9% of GDP, and the industrial base was way too small to give the country any sort of a cushion during a downturn. Then there were also structural issues. Most Greek businesses were small and were inefficient. Productivity was low, and tax evasion was also fairly high, where the underground economy or black market accounted for over a quarter of the country's output as per sources. Now, this made the government's finances even weaker over time. So by the early 2000s, Greece was stuck. Its economy was fragile, its government was overspending, and its debt was piling up. But there was one opportunity that looked like a way out here. That was joining the Eurozone. Now, the Eurozone at that point in time offered massive amount of benefits. It would give Greece access to lower interest rates, a strong and stable currency in the euro, and also a sense of financial discipline that it had never had before. But again, it obviously came with some very serious conditions. Once you join the euro, you have to give up control over your own currency. You cannot print more money to cover deficits, and you do not have the freedom to change interest rates to manage your own economy. There were also rules around debt levels where countries were expected to keep their debt below 60% of GDP. Now, for Greece, these were very, very tall demands, but they still wanted in, so they made it work, at least on paper. Now, the Greek government used some creative accounting techniques to hide its real deficits and to show that it met the Eurozone's criteria. And once it joined, the country started borrowing even more, but instead of using that money to strengthen the economy or invest in new industries, a lot of of it actually went into real estate and increasing public wages. Now, this was a house of cards of sorts, and when the 2008 global financial crisis hit, it all sort of came crashing down. So, as the crisis unfolded, investors obviously pulled off their money out of risky markets, and suddenly it became much harder and much more expensive for countries to borrow. Now, for Greece, of course, this was a bad nightmare. Its weak finances and fudged numbers came into full picture, and in 2010, the Greek government also admitted that it had been hiding the scale of its deficits. Now, of course, the markets reacted to this almost immediately. Greece was shut out of international borrowing, interest rates on its bonds soared above 30%, ratings agencies labeled its debt as junk, so in short, there was nobody who was willing to lend to Greece anymore. And that was a massive problem, not just for Greece, but for the entire Eurozone. Many European banks, especially in France and Germany, had lent large sums of money to Greece. So if Greece defaulted, these banks would take in massive losses. And kicking Greece out of the Eurozone was not even an option either, because there was no legal framework to do it, and it would have thrown the entire European Union into sort of a chaos. So the European Union, along with the European Central Bank and the International Monetary Fund, stepped in. They offered Greece a bailout of 146 billion US dollars. But this money actually came with very strict terms, which we now know as austerity measures. The idea here is fairly simple. You cut spending and raise taxes so that Greece could start paying back its debt. But the reality was fairly brutal. Public sector salaries were slashed by 15%, pensions were cut repeatedly, and the minimum wage was reduced by 22%. And by 2015, pensions were down 40% and salaries by over 35%. And not just that, value-added tax was raised to 23%. And let me tell you, this was in an economy where many people already operated in the black market. So these cuts hit regular people very hard. So with less money in their hands, consumption obviously ended up dropping. Businesses slowed down and investments dried up. Greece's tourism industry, which was, like I said, one of its lifelines, also took a big hit during this time, with revenues dropping by as much as 20% in the year 2010. Now the bailout, of course, was supposed to stabilize certain things, but the problem is that it ended up pushing the country into a deeper hole here. Riots broke out, worker strikes became frequent, people were angry, not just at their own government, but also at the foreign institutions that seemed to be dictating their future. And by 2012, Greece was in a position where they needed even more help. Another bailout of 130 billion US dollars was arranged, and this time the Troika also pushed for a debt restructure where some of Greece's debt would be written off. Private creditors had to accept losses of over 50%. This was the biggest debt restructuring in entire history. And in return, of course, Greece promised even more spending cuts and reforms. Now, yes, of course, the debt deal helped a little bit, but not nearly enough at all. It came in too late and was not even large enough to turn things around for Greece. Many investors still did not want to lend to Greece at the end of the day. So employment hit 25%, youth started leaving the country in large numbers, and by 2015, over 30% of the population was at risk of poverty. Now, interestingly, that same year, a new political party called Syriza came into power, riding on public anger. They promised to fight back against the austerity terms, and their finance minister even proposed a new plan where debt repayments would be linked to how fast the Greek economy grew. But the problem was Europe was not interested. By then, it was clear that Greece had very little bargaining power. The broader Eurozone was also struggling with its own problems, which was low inflation, slow demand, and a general economic slowdown. Now, to try and revive things, the European Central Bank started buying government bonds to inject cash into the economy. Now, this helped many countries, but of course, not really Greece. It was excluded from the program despite being a part of the same union. So with no good options left whatsoever, Greece's situation obviously ended up worsening. It missed a debt repayment to the IMF, banks were running out of cash, and people rushed to ATMs in panic. And in general, the entire country was on the verge of a total collapse altogether. But then another bailout came of about $94 billion. But once again, the price was more austerity, and Syriza had to go back on its promises. Between 2008 and 2015, Greece lost about a quarter of its entire GDP. The economy shrank more than it had during the Great Depression in the US. Many economists began to question whether the austerity model was doing more harm than actually good here. And then in 2018, Greece finally received the last installment of its third bailout. It was the end of the rescue programs and the start of a new phase for them. In 2019, a new party came into power, and their focus this time was on rebuilding investor trust, attracting foreign capital, and also reforming the economy at large. They launched fast-track approvals for investments, reduced taxes, and also encouraged privatization. And the good news is that finally these reforms have shown some results. Foreign direct investment rose to record highs in 2022. Greece's bond market is healthy once again. Earlier this year, by the way, they raised $5 billion through 10-year bonds, which were oversubscribed 10 years over. Also, its debt levels, though which are still high, are starting to look more manageable now. And their debt to GDP ratio has also dropped from 180% to about 150%, and most of that debt is now locked in at low interest rates over a fairly long period. And all said and done, more importantly, there are also signs that the structure of the economy is starting to shift. Manufacturing exports have tripled since 2008. There is new momentum in the tech space, with government supporting AI startups and big tech announcing investments worth billions of dollars. But all of that said and done, it is all not well yet. Much of the recent investment has actually gone into real estate and loan servicing, which are areas that do not do much to improve long-term productivity of the country. Tourism still continues to drive a large part of growth, and wages, despite everything that's happened, are still fairly low. Living standards have declined, and Greece is still the second poorest country in the European Union. So if you think about it, even today the scars of the crisis are fairly very visible. Public infrastructure remains outdated, tragically highlighted by a deadly train crash earlier this year, which many blamed on years of underinvestment. People are still protesting, and they are still demanding change. So the question then becomes, did the bailout and austerity fix Greece? Maybe, but the cost was actually immense. A whole generation lived through economic pain, political instability, and also personal loss. So the Greek story actually reminds us that economic recoveries, even when they actually look impressive on paper, can really be filled with deep human suffering. Other countries facing crisis should take a note of this, because while Greece may be a symbol of resilience right now, it also stands as a very, very big warning that not all cures feel like healing when you are actually the one living through them. That brings me to the end of the first story of the day. Let's now move on and talk about the second story. See, something new is brewing in India's electricity market, and it's not really about a new power plant or a fancy solar project this time. It's actually about the way electricity gets traded between people. For the first time, India is set to allow the trading of electricity futures, which is a financial instrument that lets you bet on the future price of electricity. Now, that of course is a very big shift. Until now, if you wanted to buy or sell electricity in India, it had to be a physical transaction. That means power was generated and actually delivered to somebody else. But now with these future contracts, that's no longer necessary. You can lock in a price for electricity, settle it in cash later, and never really touch a single kilowatt. Now both the National Stock Exchange, which is NSE, and the Multi Commodity Exchange, or the MCX, are going to launch electricity futures mid-July. Now mind you, these are financial contracts and not physical trades. That means nobody needs to actually generate or consume electricity. It's like trading gold or crude oil futures, where you're not taking delivery of the commodity, you're just speculating on where prices are heading or hedging your exposure. But to understand what's exactly changing here, let's first quickly take a look at how electricity has traditionally been traded in India. See, most of the electricity that flows through India's power grid is locked in long-term power purchase agreements, which are also called the PPAs. Now, these are contracts between power producers and state-owned electricity distribution companies, which are also called discoms. Now, they are usually signed for 5, 10, and even 25 years in some cases. And these PPAs take care of the country's base demand, which is the minimum amount of power that needs to be supplied around the clock to our country. You can sort of think of it like the steady, predictable part of the power system. But that said, power demand does not always stay steady. It can spike during heat waves, say fall during rain, or even get disrupted when a power plant goes offline. And when these unpredictable situations arise, India relies on something that is called the spot market. And this is where power is bought and sold for immediate delivery. Our main spot markets are run by platforms like the Indian Energy Exchange, or IEX, which conduct day-ahead and real-time auctions. So basically, if a discom needs extra power tomorrow, or even the next few hours for that matter, this is the place they go. Now, these spot market trades are physical, which means someone generates electricity, somebody else uses it, and money changes hands, so to speak. But now, the new electricity futures are very different from this. They are purely financial instruments. No actual electricity will be generated or delivered. Instead, these contracts will actually be settled in cash based on a benchmark price of electricity for a future date. Now, you might be wondering why the IEX, which is India's main platform for physical electricity trading, is not launching these futures itself. See, that is where it gets really interesting. See, it all comes down to regulation here. Electricity in India falls under two separate regulators. The first one is the Central Electricity Regulatory Commission, or the CERC, which oversees the actual physical trading of electricity. Now, this includes spot markets and also long-term PPAs. But futures and other financial derivatives are actually considered securities in India, which puts them under the jurisdiction of SEBI, which is the Securities and Exchange Boards of India. Now, IEX operates under CERC, which means it cannot offer derivatives which are SEBI's domain. Only exchanges like SEBI and MCX, which are regulated by SEBI, are actually allowed to launch these kinds of financial products. But that said, this was not always so clear. In fact, the overlap between physical and financial electricity trading has sparked a year-long turf war between SEBI and CERC. It took a Supreme Court ruling and coordination between multiple ministries to finally draw a line here. And the outcome was that if electricity is being physically delivered, it is CERC's business, but if it is just a financial trade, it is SEBI's. So that is why under this new regulatory clarity, MCX and NSE are stepping in to launch electricity futures. But anyway, now that all of us probably understand what's exactly happening, the bigger question then becomes, what does this even mean for us? See, in theory, electricity futures can be a very useful tool. Let's imagine that you are a power producer for once, especially a renewable one like solar or wind plant. Now, you might not really have a long-term PPA for all your electricity, so you're selling a big chunk on the volatile spot market. So with futures, you can now suddenly lock in a price for your power ahead of time. That gives you revenue stability and also better amount of planning. Very similarly, discoms could also use futures to manage their costs. They could hedge against price spikes during heat waves or dry spells when demand sort of shoots up or supply falls. And instead of scrambling to buy expensive power on the spot market, they could plan ahead of time using futures itself. And it's not just utilities, mind you. Traders, banks, and other financial players might also get in over here, either to hedge or to speculate on price movements. And the more the players join in, the more liquid the market becomes, which of course in turn makes it more useful for everybody. But like with everything else, there is also a catch here. See, all of this heavily hinges on actual participation from the people who need electricity, which is like discoms and power producers, and that is where the uncertainty lies. In India, public sector utilities have historically been wary of derivatives. Even in oil, where prices are notoriously volatile, Indian state-owned oil companies hedge very little of their exposure. Now, these tools are often seen as risky or unnecessary and something better left untouched. So if that mindset actually persists in the power sector, then electricity futures could struggle to gain traction. The contracts of course may exist, but if the biggest buyers and sellers of electricity do not show up, the market could really end up being very shallow. And that then creates a second problem. If the market lacks genuine participants who are there to hedge real exposure, it could get dominated by speculators. These are traders who have no stake in actual electricity but are simply betting on price movements. So while speculation adds liquidity for sure, too much of it can actually distort prices and can increase volatility, the very thing hedgers are trying to avoid. So with all said and done, yes, of course, on paper, this is a smart and timely move, but whether or not it will actually work in reality entirely depends on who shows up to trade and obviously also why. And before we get too optimistic about all these things, it is worth remembering what happened to Texas back in 2021. During an extreme winter storm, the Texas power grid failed. Demand for heating shot up, but many gas pipelines and power plants froze up, collapsing the supply side altogether. Now, electricity prices at that time soared from around $50 per megawatt hour to $9,000 per megawatt hour, which is a jaw-dropping 180 times spike. The financial fallout was absolutely brutal. Some energy companies made windfall profits and the others went bankrupt in a matter of days. Now, you would think that financial hedges would protect firms from this kind of disaster, but that is not really how it played out. Some power producers had sold power at fixed prices where they assumed that they would be able to deliver it. But when their plants shut down, they had to buy electricity at 9,000 megawatt hours to honor their contracts. That pretty much wiped them off. And even electricity retailers who offered consumers fixed low rates could not survive here. They could not pass on the inflated costs and they defaulted on payments. One of Texas's largest electric cooperatives filed for bankruptcy after receiving a $2 billion electricity bill. Now, of course, course, all that said and done, India's power market is very different. Our grid is centrally controlled and is very highly regulated. So the chances of a Texas-style grid collapse are fairly less. But still, the lessons from the crisis apply to us. Electricity is an unpredictable commodity, and when financial instruments like futures are added to the mix, you are introducing a new layer of complexity and also interdependence. A failure in one corner, whether it is physical or financial, can very quickly spread. So while electricity futures could definitely bring in more flexibility, transparency, and also planning power to the Indian electricity market, they also demand strong oversight and sound risk management. That brings me to the end of the two stories of the day. On that note, let's move on to the final section and talk about the quick news headlines. First, in an earlier episode, we had looked at how major Indian hotel brands are placing long-term bets on location, consumer segments, and asset-light expansion. And now, Marriott's next move shows just how those trends are accelerating. Ventive Hospitality recently signed several new hotel deals with Marriott International, adding about 1,500 rooms to its portfolio across India and Sri Lanka. Over the next 4 years, these will roll out across spiritual business and leisure destinations, including Varanasi, Mundra, and even a Ritz-Carlton Reserve at Yala in Sri Lanka. Second, we'd spoken about the burden of India's push for steel self-reliance on MSME manufacturers who depend on imported steel. It now looks like the government had been looking at it as well. The Steel Ministry has now deferred the 13 June Quality Control Order or QCO on finished steel imports by 4 months after small importers flagged serious concerns. The rule would have forced all importers to ensure BIS certification, not just for finished products, but even for input materials used abroad. This would have disrupted shipments already in transit, many of which were ordered months ago. But regardless of the QCO being deferred, India's steel import spree has slowed. This has brought domestic prices lower than Chinese shipments in the first quarter of 2026. The drop eases pressure on local mills and may signal a turning point in protecting India's steel industry. Third and the final one for the day, AI no longer really only exists on our phones and laptops. It is very quickly moving to our glasses as well. Maybe we will have even more developments in this field before our next monthly AI roundup. But for now, the update is that Meta has scooped up nearly a 3% stake, which is about for 3.5 billion US dollars in eyewear giant Luxottica, marking a major push into AI-powered smart glasses. The deal deepens Meta's long-standing smart eyewear partnership, which fuels its ambition to lead in wearable AI tech. That's all the news and stories I have for you today. I hope you enjoyed this episode. This is your host Anurag Bansal signing off. Take care and have a nice day. Disclaimer: this content is for informational purposes only. None of the stocks, brands, or products mentioned are recommendations or endorsements.